Okay, and then old rule of money is invest for the long term, and most people say invest in mutual funds. I personally don't invest in mutual funds, and most people, it's not a bad idea. But if you want higher returns with less risk and less taxes, then you have to first invest in your financial intelligence. So mutual funds have its place for most people, but I personally don't invest in them, and I'll go into why. So when somebody says invest for the long term, one of the problems I have with that is, what does that mean? Because that's the old rule. The new rule is you have to know the difference between buy, sell, and fool. And so when I'm buying and selling something or investing, this is the difference for me, okay? When I buy, let's say, a house or an apartment house, I buy it long. That means I want to hold on to my real estate forever. But what I do is I sell it every 30 days to my renters. So I hold the property forever. All these guys who are flipping property, the problem with flipping property is that you have capital gains tax all the time. You're losing money to taxes. It doesn't make sense. So buying, let's say, an apartment house, I have, let's say, a 500-unit apartment house today, and I started off with little individual houses. You know, the rule for getting rich is from Monopoly: 4 greenhouses, 1 red hotel. 4 greenhouses, 1 red hotel. So I started with small houses, and today we have big apartment houses, big commercial buildings, things like this. But the principle is the same, whether it's a small house or a big house. So I buy it. I intend to hold it forever. I'm going to pass it on for generations, but I sell it every 30 days. The same with oil. The other day I was filling up my gas tank, and I got really upset. It cost me $72 to fill my tank of gas. And the reason I was upset, because I was a buyer of gas. But then I went home that afternoon, and I found oil hit approximately $140 a barrel. So then I was happy again. You see, on one side I was a buyer, which I was unhappy, but as a seller of oil, I was happy. So this is my point here. If you're going to be rich in life, the reason most people are poor is because they're primarily buyers with very little to sell. You know that old advice I talk about financial education: go to school and get a job. So let's say you sell your time. You know, I'll sell it for $25 an hour. If that's all you've got to sell, you're not getting ahead, because the Federal Reserve keeps printing money faster and faster. You have to work harder and harder, then you get taxed harder. So if you're going to be rich, the thing my rich dad taught me was you have to have something to sell every single month. So every single month I'm selling my apartments, my units, for 30 days at a time. I'm selling my oil, you know, on the open market. And you look at what I did, even though I flunked out of high school twice and I couldn't write, and because I really couldn't spell, is when I write a book, I write it once, but I sell it into 100 different languages throughout the world. So every quarter I'm getting a paycheck. So to be rich, it really understands the new rules of money requires you to know when you're buying, when you're selling. And that is essential to being rich today. Now, when I talk about the fool, it's called the greater fool theory. So like being a real estate guy, I go out there and somebody says to me, oh, this house is $100,000. But next year, it'll be worth $200,000. Generally, that's what's, you know, what do you call those guys? Real estate brokers or mortgage brokers or stock brokers. As my rich dad said, the reason they're called brokers is because they're broker than you are. So they're telling you to buy this stock or this house because the price will go up. Again, that's capital gains, not cash flow. And then you become the greater fool. You know, the people, unfortunately, who are hurting financially today in the housing market, they were the greater fool. They bought the idea that the price of real estate would keep going up. Well, as you and I all know, prices go up and prices go down. So if you're going to, the new rules of money and the financial intelligence and your financial education requires you to know, to be balanced, be both buyer and seller, and not be the greater fool. I say it again. When I fill up with gas, I get angry because I'm a buyer, but I'm happy because I'm also a seller. If you're going to be rich, you should be selling more than you're buying. One last thing is the one reason I really don't care much for mutual funds is because I don't know if you're the buyer or the seller or the fool, but I'll make that decision. If you're the investor, then you put up 100% of the money, and I think you take 100% of the risk. It doesn't make sense to me. Same as you put money in the bank. And the mutual fund company, they put up 0% of the money, but what they get is 80% of the returns. So this is why I really don't recommend, but it's good for most people. Put your money in a mutual fund and just let it sit there. But what happens is you take 100% of the risk, you only get 20% of the returns, and you put up 100% of the money. That doesn't make sense to me. That's why I like to use debt, good debt as leverage and things like this. But again, this is your greatest asset right here. So I don't just blindly invest for the long term. I don't park my money. And the reason I don't park my money in the bank is because I said in 1971, the U.S. dollar stopped being money and it became a currency. The word currency means current. You must keep your money moving. The people who are losing financially today are people who are parking their money in long-term things like savings account and mutual funds. That's good for the average person. It's good for the average investor. And it's better than nothing. It's better than being poor. But you're not getting ahead with old information or old rules of money. I'll just pass this last thing along for those of you who say, well, I don't want to be an investor. It's too much work. I understand. It was years ago, a friend of mine, a friend asked a friend of mine, says, what would you say to the average investor? And my friend, who's a very rich man, said, what I say to the average investor is, don't be average. Because today, in this high volatile environment, the average people, the middle class, are getting wiped out. So, those are the new rules of money. You don't invest for the long term. You have to know when to buy, when to sell, and when not to be a fool.